Hello, and welcome to the third event of Nordic Battle of Treasury, a recurring event hosted by, well, PwC. The purpose of today of the Nordic Battle of Treasury is to create a platform that enables you to clearly understand and visualize the technology opportunities that can solve any business challenge that you might have. My name is Kasper Borli, and I will be your moderator of today. And when I'm not doing this, I'm running the Treasury Services as part of the Financial Services at PwC, where we try to assist our clients in making the right decisions for them in the space of Treasury. I'm sorry we were a little bit late, but we had some minor technical difficulties, but they should be solved now. So, what's our subject of today? Well, we have invited 4 vendors that's waiting eagerly to present their solutions to you, and we'll get back to that very shortly. The solutions that they're going to present is how to make the best way that they can support in making FX hedge decisions. For that reason, I have brought my distinguished colleague that's a subject matter expert in the risk management area, and he will shortly introduce today's subject to you. But before we get to that, I have a couple of practical comments that I would like to share with you. We have a tight schedule today where, well, as usual, where the vendors will have 10 minutes to give a short presentation of that part of their solution that today supports the FX hedge decision. And after that, we have 5 minutes of question rounds. So that means that you, the audience, while they're doing their presentation, you have an opportunity to, if you see below in your screen, to post whatever kind of questions you might have to the specific vendor. After the question round, Peter and I will prioritize these questions and post them back to the vendors. And in that case that we will not have time enough to answer all the questions, we'll make sure we go back to you afterwards on your specific questions. If you have any questions to the format or the concept or the specifics after today, please feel free to reach out to either Peter or myself, if anything. So, without further ado, Peter.
Thank you. As Kasper said, I'm Peter Lindebjerg, and I'm subject matter expert in risk management and also part of financial service at PwC. This session is focused on the front and middle office FX risk management challenges. We have invited 4 vendors in order for them to present how they have chosen to let their TMS solution support Treasury when FX risk management decisions have to be made and executed. I've been quite excited to experience where temporary TMS systems have developed and now to share the experience with you. Also, how much does the client actually desire the TMS to support as an FX hedging support tool? I'm quite certain that many of you treasury managers all have your self-constructed Excel sheets, Python scripts, or other support system for pricing the actual FX trade. In other words, you are able to challenge banks and brokers when it comes to the actual trade decision. After all, the TMS system is normally not a trading platform. But do treasury managers exploit all the FX portfolio information contained in the TMS system to do portfolio analysis before deciding which trades to execute? That in order to best mitigate FX risk. And just as important, do the TMS system present these information in a contemporary way which facilitates and supports such decisions? We had invited 4 vendors to present some of these their solutions which best support treasury managers when evaluating FX hedge decisions, namely G-Treasury, Fidelity Information Systems, ION, and Kyriba. So after participating in this session, you will have an insight into what direction some of the TMS frontrunners vendors are developing and what they can currently offer in support of the FX hedge decision. Before we kick off, I would like to outline how we have chosen to set the scene. In PwC Treasury Group, we have many years of practical experience, also with the FX hedging decision. Hence, we quickly agreed to two things. Firstly, the Treasury managers need a solid dashboard overview of the current risk situation, including bank accounts, ERP input, forecasted cash flow projections, and already established FX hedgings on the book. It would be desirable if the Treasury policy was also reflected in the dashboard, such as hedge requirements, counterparty risk limits, and other topics. Secondly, after having established the ground we stand on, it would be desirable if the TMS could help create a portfolio risk picture. We do realize that the actual trade situation is often facilitated through a trading platform. But what if analysis and scenario analysis could be well supported using the TMS system as well? Since market information, possible macroeconomic forecasts, and scenario projections might form a possible input to the TMS. So we think these two dashboards will be very important, and they're going to be the center of these presentations. Actually, this analysis is most often much more important than whether we get the last pip squeezed out of the bank or the broker. That is, in my opinion. So let's have a look and get rolling with some presentations. Casper, please.
Yes. Then I would like to introduce you briefly to our first vendor of today. Is everything working with the technical stuff? Yep. Super. This is G-Treasury. That is going to be the first vendor of today. G-Treasury is not that well known in the Nordic market. So that's what we are trying to give you some idea of now what another provider than you usually see can provide. You might have been acquainted with the Visual Risk that was acquired by G-Treasury a couple of years ago. And G-Treasury has a wide platform in the treasury space. But today, of course, we're only going to look into the risk management and hedging. And hence, we have with us today Hamish Wells that's going to take us through G-Treasury's presentation. Please take it away, Hamish.
Perfect. Thanks a lot, Casper and Peter. First of all, thanks a lot for inviting us in a very exciting format to be part of, and certainly very excited to share our solution with the wider Nordic Treasury world here as well. So, look, as Casper mentioned, we may not be that well known in the region. So what I'm going to do to start with is just spend a couple of minutes really quickly introducing the audience here to G-Treasury, what we're all about, and where we come from. So, look, you'll see here a range of information on the slide presented. First of all, it is worth noting that we are a very established player within the Treasury space. We've been focused solely on this for over 30 years. And a lot of that we've been really bringing a SaaS solution to the market. So well over 20 years of actually offering a SaaS solution to the wider Treasury space there as well. In terms of how we're distributed around the world, you can see there we've got offices in the US, where our headquarters is based in Chicago. We've got offices out of EMEA. We've got offices in Sydney, Australia, and also centres throughout Southeast Asia there as well. And I'll let you read the rest of the information on that slide. But one I really want to highlight on is really the growth strategy and the growth achievements that G-Treasury has been able to sustain over the previous couple of years. We've gone through 2 years of record-breaking growth. A lot of that really centres around exactly what we're going to be running through today in terms of risk management, in terms of hedging strategies, and in terms of a lot of the wider capabilities in that space there. So moving on into the actual, so just getting through the slides. Moving on to the actual, the main event in terms of what we're here to talk about, and really the tools for FX hedging and decision making around all of that. Now, I want to take you on a bit of a journey today in terms of the end-to-end and the way that G-Treasury really does allow our client base, allow our users to really manage all elements of this decision-making process. So we will really start as that first step in the process there, and really consolidating your positions, seeing where you're sitting, seeing what your exposures are, and seeing where you're currently sitting from a hedge perspective there. we've got a lot of tools, first of all, to bring in the exposures, to give you the visibility you need. These exposures can come from a range of different sources. You could be more focused on a cash flow hedging strategy where you're pulling in revenue or cost projections from maybe a cash flow forecast or from different subsidiaries or different business units. You might also be focused more on the balance sheet exposure side, where you are more protecting that P&L volatility as opposed to the underlying earnings and cash flows there as well. No matter what source of exposure you are using there, we have a range of tools to both consolidate that, but more importantly, actually provide you and front office very quick and easy visibility into where you're currently sitting. So we have specific dashboards that come out of the box with the system. You can see a couple of examples here. You might want to look at it more of at a chart perspective, so you can very quickly and easily establish where you might need additional cover, where you might want to investigate further. You might also want a much more detailed breakdown that you can see in the bottom there, where you can see exactly what the numbers are. You can see exactly what rate you're achieving on your hedges, pull through market rate information so you can see exactly where you're sitting from a position perspective. And also on top of that, all of the potential cash flow outcomes if you are more focused on the cash flow hedging as opposed to balance sheet hedging there as well. So that's the first step. That's really looking at where our positions are, seeing how we're currently sitting, exposures versus hedges. We can then continue on that journey and really go down the path in terms of using all of the tools within the system to establish exactly where we sit in terms of policy, in terms of our risk policy, see how we're sitting from a compliance perspective, and also add that operational efficiency in there so that you're not able to breach policy, you're not able to go over your limits, you're not able to get in trouble with your management if you do overhedge or trade in a derivative that you're not meant to be trading in. So there's a lot of tools embedded within the workflow here. These are just a sample of those. You can see the first example there really showing you exactly how you're sitting versus your own internal hedging policy. See what sort of headroom you've got in each bucket that you're hedging, all configurable, so you can really create the view and the visibility that does fit within your policy. And this will give you both a maximum and a minimum. If you are more looking at a benchmark, there is a particular level in terms of notional hedging you're looking to achieve. The system will also be able to present that information so you can very much see how you're sitting. Likewise, on the front office limits, you can manage all of your counterparty limits. Again, very visually appealing dashboards and charts. So you can see exactly how you're tracking against all of your counterparty limits, individual trader or dealer limits. You can even embed approval limits in there for certain notional size or type of deal. So really the full suite in terms of making sure that all of your policy, all of the internal compliance elements are very much adhered to there as well. Now really it moves into the fun stuff, and this is where G-Treasury has always excelled. This is really part of the reason why we are on such a high growth trajectory and so many people are choosing G-Treasury. And it really comes down to this user-friendly, dynamic scenario analysis that we do have within the system. Now, I've only picked out one chart here to showcase this, but there is many charts that come completely with the system, designed hand in hand with the corporate market to make sure we're satisfying exactly what we see in terms of these decision-making processes here. So what you're seeing on the screen here really is an example of one of these charts, looking from a position perspective and really encompassing all of the different elements that go into this decision-making process. On the left-hand side, we've got the current position. We can see what the current hedges are. We can also split out any natural hedges that might be in place if we're looking at cash flow hedging. That could be from a cost versus a revenue from a particular business unit. It's also incorporating our policy in there as well. So we're getting a very comprehensive view of all that's going into this. On the second chart there, you can see we've actually overlaid a what-if hedging strategy. So you can add in these strategies through a very simple manner. You can very quickly reanalyze your outputs directly under these different circumstances and see exactly how you're going to be sitting from a policy perspective. Charts that aren't in here that I haven't included would be also allowing you to analyze what the cash implications or the effective rate implications, P&L implications, would be if you're actually to initiate this plan. You can create multiple different market scenarios, so you can analyze under all of those different conditions exactly how your policy, how your strategy is going to perform before actually initiating it. This has a lot of uses. This can be used just for testing out a strategy. It could be used for further decision-making elements. For instance, if you wanted to move into a new region, you can measure the cost of carry. You can measure some of the market risk implications of hedging a new currency or hedging in a new region. And it really does give you comprehensive visibility over all of the potential outcomes. It really helps you understand the underlying risk that does arise from these exposures that you are experiencing here as well. Now, we can take this one step further and move to more of the advanced risk tools. Now, there's obviously a range of tools that are available in the market to provide much more comprehensive and more scenario-based, simulation-based approaches to risk management. But where we really stand out here is really in terms of the visibility that we provide. The two models that we're highlighting in this particular slide, CFAR and VAR, these will primarily depend on what your hedging strategy is. Are you hedging P&L volatility? Are you hedging cash flow volatility? But both have a lot of merits, and the system really provides the heavy lifting in terms of creating these scenarios. The system will use Monte Carlo base for CFAR. You'll see the distribution exactly of the cash flows that will eventuate in that under all of those simulations that are generated through the system there. And what you can see is, again, overlaying that what-if strategy. So you can see quite simply and quite clearly in this particular instance, the top left-hand corner, you can see exactly how much volatility, how much cash flow volatility is actually decreased from a particular strategy that you put in place there. You haven't got that major spread in terms of potential cash outcomes, and you can see the effective rates that you'd achieve on your portfolio under those thousands of scenarios that are generated there. The second one there, in terms of VAR, that gives you more the value at risk metrics as opposed to the cash flow based, and you can use the historical simulation based approach there. So use historical market data to project forward into the future to determine under what conditions your strategy will be in place there. So just jumping through the last couple. Oh, sorry, go ahead.
I just want to know you have 30 seconds left.
30 seconds. I have got my timer on, so I was aware of that. I'll race through the next two here. So
they're all very interesting, but the clients also would like to give you some questions.
Yeah, sure thing. So the final two here, I'll be very quick on this one in terms of trade execution, really allowing a simple platform for users to be able to capture these trades. That includes integration with the trading platforms that Peter touched on earlier, automation with middle office confirmation platforms. We've talked about the embedded limit validation, but really end-to-end processing right through from front office through to back office settlement and accounting, and really a full suite of deals to be able to capture a range of different instruments there as well. Final slide here. I won't go into too much detail, but there is a lot of other available functions that you can overlay over the top of this as well, particularly around hedge accounting. If you are doing cash flow, if you are doing a cash flow hedging strategy, you can limit any P&L movements under the relevant standards and get all of the information directly out of this. So I'll leave it there. I think I've run about 30 seconds over time. So back to you, Peter and Casper. I'll welcome any questions.
Thanks, Hamish. I'm not sure exactly how we'll cover it, but don't worry. We'll have some questions we got from the audience. Peter, yeah. Can you please?
Yeah, thank you for the presentation, Hamish. It's always delightful to hear somebody so enthusiastic. A couple of questions with regard to your risk. How should I say? What if analysis? You say historical data. Now, would one be able to basically shift back? Let's say one had a financial period or a COVID-19 period one wants to stress test the current position on. Would that be possible?
Yeah,
I mean, to switch the data.
Yeah, it's actually a really good question, and certainly something that we highlighted over GFC, and it was the reason we made quite a big change to the functionality over that period. Obviously, there was a lot less volatility in all markets, and including FX markets, leading up to that period, and certainly prior to COVID as well, there was quite a long period of, I guess, lower volatility than we've seen over some of those high volatility periods. So if you do want to get a good overview of what your true risk is, what your true exposure is there, that is quite an important feature. So within that VAR model, you can, the historical based VAR model there, you can specify the time horizon that you're using from a market data perspective. So you might want to use the last year, you might want to use the last 6 years, you might want to go back to 2008, 2009, where there is higher volatility. So you certainly can do that, and that's all delivered in quite a simple method through the platform there as well. So a really good question.
Then the question to more the practical side, because we did see an input picture and so on. I mean, in order to pose these what-if questions, what would one do? Would one input potential trades, label them something specifically, and then run the analysis with these potential hedges, or how would one do that?
Yeah, we actually have a very simple workflow to enable that. So first of all, you can pull through all of your live trades, all of your live positions. So that's both on the exposure side, all of your exposure profiles, and the trade side as well. But in our analysis tool, we do have a very simple mechanism just to capture what-if trades, and it's really designed so that you can do that ad hoc modelling, you can do that ad hoc analysis, and really change things up, add in different rates, add in different deals, add in different types of strategies, whether you want to look at options, look at collars, look at a range of different trades there. Add those in very quickly, and then very simply reanalyze the portfolio, and really in under a minute you'll have the outputs once you've actually captured the ad hoc trades you want there.
Thank you.
Thanks, Samish. I'm sorry we don't have more time for Treasury now. We will quickly slide on to the next presenter for today, which was, as you mentioned earlier, Peter, Fidelity Information Services, or yes, thanks, and which we have some technical difficulties. Good, thanks. Well, FIS, that most of you are quite acquainted with. So the question today was barely that FIS has two systems in this space, quantum and integrity. So looking at you, Andrew, can you tell us what have you brought us today? Because basically you can answer these questions with both your solutions.
Absolutely. So hello, everybody, and to PwC, thank you very much for having me on this panel. So today, as you say, we offer quantum, an enterprise solution, and integrity, which is a pure SaaS solution to the market. I'm going to be walking through today with regards to the question around FX management and exposure risk mitigation, and with regards to how integrity will cover this challenge that all treasurers face today. So to briefly introduce myself, my name is Andrew Winders. I'm Senior Manager of the Business Solutions Group at FIS. And as I said, I'm going to walk through today how integrity will manage these challenges that we see. So a question for everybody, a rhetorical question. Have you ever really had control over your exposures? I personally used to work in a large multinational treasury, and I can confirm that in that position, we had the constant battle around timely reporting, accuracy of data consolidation, risk assessments, overlaying policies, all those things that we should expect technology to do for us today. This is really what our customers are looking for today. A good example of this is one of our customers in the cosmetics industry that's hedging very high volume, low value items. So lots of data, lots of intricate hedge policy decision making, lots of shifting of exposures. How do we expect technology to manage this? And this is what should be your question to all vendors. In terms of the platform itself, integrity is all about having access to the exposure data, having visibility into your positions. being able to make real-time decisions across all of that data, being able to manage your hedge initiation, your hedge execution. And this is driven via the platform, the enforced step-by-step user-defined workflow process. And of course, the risk mitigation. This is the point of the question today. Your exposure portfolio risk management, can you really exclude risk from your positions without a best-of-breed technology platform? I think probably not. So in essence, this is what integrity is encapsulating. It's the ability to manage the end-to-end workflow from the initiation of the capture of exposure to the cover of that exposure to the back office workflow and to all the risk management parts of the process. So what should you expect from a Treasury platform? A standardized FX risk management process using a platform with carefully predefined enforced processes. So the first thing a platform should automate and control for you, the collection of your exposures, being able to automate the collection of those exposures and update your positions in real time. Managing your policy, so overlaying your policy on top of those exposures. Being able to execute your hedges off the back of your hedge policy position, either manually or automating the plug-in capability into dealing platforms that Integrity offers you today. Being able to manage your risk, not only hedge policy risk, but your counterparty exposure risk, your valuations, your value at risk, your cash flow risk, your scenarios, being able to overlay all of that risk analytics on top of your positions. And then we have the back office process. So post-execution, what happens to the back office workflow, the approvals, the settlements, the confirmations, all the IFRS 9 and accounting expectations. So being able to manage all of this process in a standardized workflow. So what do I mean by that? You should expect technology today to deliver a simplified workflow for you, but to have you as the user being able to define what that workflow is. And the point of that is to be able to standardize your process. So once you have your workflow defined, having access to your KPIs at all times, to be able to see whether you've covered the important KPIs and have all of that measured against your predefined process. So this is technology that simplifies the user experience, enabling the definition of your Treasury framework. Your Treasury platform should really be your internal audit. So once you have your internal workflow, you should be able to standardize the key decision data and the processing capability from a single location. So from an integrity point of view, you as the user can construct your own front end, your own screen. What do you want to have on a single page? Here, I'm representing some of my key KPIs. What do I really need to be aware of when I'm managing my FX exposure workflow? I also may want to have some graphical analytics. So what is my current hedge cover, we see on the left, and on the right, what is my current hedge cover, including all of the deal requests that may have come through from my subsidiaries that may not have been processed so far. And then in addition to that, I want some key indicators around my policy and my general portfolio. But the point here is that you can control what the front end contains. So you as a user are going to drive the content so that you've got access to all the information at the right time without any navigation required. So what do we also offer? You can also truly enforce the workflow and enforce your policy and measure against market movements. So what do I mean by that? Here we've got the policy, you've got the workflow. You can drive the step-by-step process, have everything contained in a single page so that navigation is completely removed and you can touch on all the relevant points for all your decision-making. We also have your policy highlighted here. So having instant updates to your policy as soon as exposures change and hedges are booked, updating your policy in real time. And we also have validation against external market data. So having market data embedded into the application means that platforms got access to all the data to really give you the workflow that you require to mitigate the risk on your FX positions. So looking at the risk itself, what does risk really mean? So risk here is not only the policy. risk is not only being able to generate a valuation, there's also the counterparty risk. And counterparty risk can be complicated in terms of building in lots of different factors. So not only counterparty risk from the FX point of view, counterparty risk in terms of bank balance position, in terms of investment portfolios, in terms of all of those other data elements. So having a very strong capability to measure your risk against your counterparties, but to facilitate the execution of all of your hedges to mitigate your FX risk. Now, what does FX risk also cover? So not only the counterparty risk, is also the at-risk metrics, so value at risk in this case. So being able to really deliver out-of-the-box risk capability, the value at risk, the cash flow at risk on the Integrity platform, being able to analyze the tails, ensuring that the ends of the bell curve are managed appropriately. But not only managing that, having control over the calculation. So the FIS Integrity platform incorporates a Monte Carlo simulation approach to drive the end-to-end risk management analytics out of the box. But you can also consider what-if analysis, scenarios, or the other forms of risk assessment. So what have we covered here? What does FIS Integrity really focus on? So for foreign exchange, it focuses on applying policy, enforcing your policy, making sure you are never out of policy. It focuses on accurate policy control to mitigate and neutralize P&L volatility. And it also just completely mitigates all of the exposures that you're managing, really kind of trying to optimize your hedge ratios. And what does this mean from an integrity point of view? So we want to really enforce the control. In the Integrity platform enforces the user control defined by the Treasury best practice. It also now allows you to measure your positions pre-deal and post-deal. It gives you the ability to execute your hedges and all the workflow related to your FX risk management workflow. So executing hedges using the all the integration that's out of the box into the dealing platforms, automating and utilizing all the market data that's available out of the box for all of your IFRS 9 calculations, for example. Now, this is also not only for foreign exchange, this also incorporates all forms of risk management. For example, your interest rate risk, as we see here. So managing interest rate risk with the same principle of having your KPIs around your interest rate portfolio, managing commodity risks with the dedicated commodity module. So lots of other risk management is capable within the Integrity platform. So I now invite you to pose any questions, and I thank you for your time to allow me to present.
Thanks, Andrew. I think I forgot to mention in the beginning that the slides will be available afterwards, as usual, and you can also see this video afterwards on our PwC website. Peter, can you bring us?
Yeah, thank you, Andrew, for your excellent presentation. I have a question. I guess just want to highlight what you were mentioning yourself. So the construction of the dashboard is entirely up to the user. You can actually, how should I say, compose the dashboard as you want it. Is that correctly understood?
That is correct. Every user can configure their own dashboards with no technical expertise required whatsoever. It's effectively a template, and you are selecting the analytics, the processing, the notifications that you need, and you're placing them on the screen to meet your own user requirements.
Okay, then back to one of my favorite questions about the risk analysis, because you were showing this risk distribution and so on. Again, a bit as I asked Hamish as well, I'm going to ask you the what-if questions. I mean, would one suggest a hedge portfolio or some hedging trades, and would one then be able to see, to flip back and forward with the slides and see how the tails have diminished and so on? I mean, is that a what-if analysis one can do?
Yes, precisely. So the risk analytics can sit on top of the current live portfolio and on top of the live portfolio plus the what-if analytics. So what that allows a user to do is to create or simulate that potential hedge and see what the impact of that hedge may be in terms of the tails, in terms of the counterparty risk, in terms of the hedge policy, in terms of all of the aspects of measurement that the user may utilize.
Okay, then I guess one final obvious question I have to ask you is that with this fantastic integrity, what about quantum? What is the difference in few words? Would you put some words yourself to that?
Yeah, absolutely. So integrity is all about standardization. So a true SaaS platform with all of our customers on the same version. So everybody's taking advantage of the latest functionality. Quantum is very much an enterprise product whereby if users require some dedicated functionality that maybe doesn't exist, then there's the option of having that created and putting that onto the environment for the user. So integrity is more about standardization, and quantum is very much at the enterprise level for the unique requirements of the customer.
Excellent. Thank you for clarifying, and thank you for answering the questions, Andrew.
Good. Well, thank you, Peter. That brings us to our next vendor for today. Iron is also a name that's not that well known in the Danish market, or that's perhaps an exaggeration, since Iron has a lot of products that is well known in the Danish market, like IT2, Findur, Reval, and the Wall Street suite. So the question, kind of like it was with the FIS, just even more with Iron. Exactly, Jack Duffy, what have you brought with you today to present for us?
Hi everyone. So let me just move on. So move on to a really good introduction of Ion just there, but just to explain a bit of the background for those of you that aren't aware of Ion as a company, but probably recognize a few of those products you see along the top. So Ion pursues what we call a multi-brand portfolio, a multi-brand approach. And we do that because we believe no one treasury is the same. The level of complexity can go from the really simple cash managers right the way up to the most complex sort of Fortune 50 central banking customers in the world. And that goes the whole way from the simple legs of Treasury right up to the level of sort of Wall Street Suite and Findur OpenLink as well. But as a treasury business today, Ion has over 1,100 customers, and that allows us to see FX risk management done in a range of complexities, but also a range of different methodologies and a range of different applications as well. But today we're going to focus on Reval. So like Hamish and like Andrew before me, I'm going to speak about our SaaS offering and how that helps customers to manage their FX in a super effective way, and really leveraging technology to do the legwork and the hard work. But before we do that, so it's always a good question to ask, are what are the prerequisites so this please do something down with the dark text there, prerequisites for best of breed FX risk management. So essentially asking, what do you need to do in a system in order to get up and running and to actually start doing risk management on a proactive basis? Well, you need your exposures. So like Hamish and like Andrew explained, exposures can come from any range of places, whether that be your forecast, whether that be your ERP systems, AP systems. We can connect third parties quickly, easily, and in an automated fashion. We need to know more about your hedges, so your hedge exposures and your hedging instruments that you have in your portfolio, so whether it be swaps, forwards, options, or anything else. And also then your treasury policies internally are always important to know, because that's what we're aiming for, and that's the kind of risk we're trying to mitigate at the end of the day. And with a platform like Reval, because it is SaaS, because it is out of the box, because everything can be done without any technical expertise, you get your risk analytics. Important to know your position and what the impact of market trends will be, but also then you have your standard reporting for things like hedge accounting, IFRS, and for other corporate mandates and corporate policies. And what I wanted to frame it like today was that we see really three very distinct kinds of customers in terms of FX management. So again, going from the simple right to the most complex, we really see people being reactive, so doing what they need to do on the basis of as and when they need to do it. Customers who are proactive, so maybe just leverage the technology a little bit more just to make sure they get the most out of it and what they need to do day to day. and then advanced customers who leverage kind of the most advanced functionality that we have on offer in any of our products, inclusive of Reval. So I'll start with the basics and the reactive. So building the baseline with the fundamentals of FX. And I think, before me, Hamish and Andrew did a brilliant job of touching on this, but this is really kind of the first step into the world of TMS and using it as your system of record. So for the top left, your trade capture, inventory reporting, alerts and warnings, and importantly, audit and workflow to ensure everything's approved and recorded in a timely and a accurate manner. Your level of cover reporting. So looking at what's your treasury policy? How do you report on that and make sure you're compliant? What is the short, medium, and long-term view that I need to have in order to understand what I need to do as a risk manager or as a front office dealer for FX in a corporate? And to do that, I want platform integration as standard. So I want to connect to the likes of FXall or 360T or any other dealing platform to make sure I can execute trades and have that flowing back STP into my system of record, which is my TMS, with end-to-end audits, bid captures, and importantly, your confirmation matching, all integrated, all solidified, and all accounted for in one place. And then finally, accounting, which will really be your statement accounting. So going out and in on your balances, realized P&L, unrealized P&L, and importantly, hedge accounting, as you want to make sure that there's no volatility in your profit and loss statements. But really, that's what we see as the baseline. And this is what we describe as a reactive customer because they're really just getting to grips with FX. They really want to make sure they're just complying with their FX policies. And typically when you're looking for your first TMS or just upgrading to start doing FX in your TMS, getting away from spreadsheets, these are the baseline functionalities that customers tend to look for. Then when we get a step further, we start to see customers becoming proactive. So they start looking at what-if analyses. They start looking at scenario analysis. They start really wanting to understand what is going to happen before I even do it. So being proactive and understanding what the best decision is for them and for their FX risk management. And that's how they do that. And technology enables this by giving them things like what-if analysis out of the box with direct access to reports, with dashboards that you can design and build yourself. So that's to know what happens if I carried out a trade and it was a certain batch of trades, so a batch of forwards and options. What does that look like before and after? What happens if I execute trades at a certain price and my achieve rate before and after? It lets corporates do this on a proactive basis. In terms of stressing market data, they can do that so they can see what is the impact of my portfolio if certain market rates change. What happens if LIBOR goes up? What happens if the USD GBP goes up? What happens if any different rates move, change up or down? They can see the impact of that on their portfolio, and they can see that at any kind of time the whole way back. Historically, there's no limitation on when you can report that. And like before that we mentioned, that can be done on a periodic basis as well. So whether you want to look at 2008, you want to look at the start of the COVID pandemic, you can simulate macro events by building these scenarios in together. So what happened during COVID? What if there's another wave? What does that mean for my portfolio? What does that mean for my decision making? What does it mean for my compliance and level of cover? And the same for something like a financial crisis. What does that mean for me as a corporate? And what do I have to do to ensure that I minimize the impact to my treasury business? And what kind of trades can I do to ensure that that is protected? And that's what we really see as proactive. They've got the fundamentals locked down, and now they're leveraging that technology to ensure that they can do some more advanced analysis and understanding of what they have to do as a treasury. And then I want to talk about the advanced, so the very top end of the market, really where we're looking at very large global corporates who have many different exposures around the world. They've got many different currencies on their books, and they really need to manage this not on a one-by-one basis. They need to start looking at how their portfolio is interacting with itself, how it's actually doing some natural hedging, and using advanced analytics. So in this case, cash flow risk is what Reval offers, in order to not just reduce risk, but ultimately with good reporting and intelligence analytics, reduce costs as well. So typically we don't see one without the other, but in this case, a CFAR can be a massively powerful tool in order to do that. So like we looked at with Treasury and with Integrity, Reval's got an analytics program using Monte Carlo simulations that allow you to understand the potential short flows or shortcomings by using cash flow risk analysis to do that. And the really important differentiator of Reval is that you've got market data provided right out of the box the whole way back to the year 2000, meaning you can simulate any period of time using this Monte Carlo simulation the whole way back to the year 2000 on day one. So it's not something you have to wait or integrate for. And it's a very powerful tool to do that. So you're up and running quickly, but you're also achieving results almost straight away. So here we're looking at an example of yes, or nice bell curve, and we can see we're comparing two different portfolios. So where am I starting versus what is the cash flow at risk when I'm laying over a hedge portfolio, whether that be what if, an actual derivative portfolio. But it's also giving me other kinds of reports like the grid that you see in front of you. And this is what we call our optimized analysis of your foreign exchange portfolio, where it looks at different asset groups across different currencies around the world and intelligently gives me an optimized order of what I should hedge first, second, third, fourth, right down to last, in order to reduce costs and transactions and in order to maximize the impact of any transactions that I make. And it's really important to understand this, because not only does it reduce what you have to pay with your banks, but also then just reduces the work of Treasury overall, doing day-to-day things like executing trades. And the example of this I want to show is like looking at maybe my top 4 different asset classes, so sterling, rubles, Canadian, Aussie dollar. If I were just to hedge those, I have a really nice, succinct, middle-of-the-road curve showing a very low risk profile if I hedge the top 4 exposures that I have in the optimized order that Reval gives them to me. If I were to do something maybe without a cash flow risk analysis or for a slightly less intelligent kind of reporting tool or capability, so say, for example, I decided to hedge some of my Mexican dollar, pesos, Japanese yen, HKD, because I felt like maybe there was a different exposure profile and a more intelligent thing to do. Reval's going to tell me no, and it's going to tell me very clearly, succinctly, and easily, because you can see the widening of that bell curve and the increase in the risk, because I didn't do what was recommended. I didn't do what was optimized. And with Reval, it's always surety that that's not going to happen when it looks at your portfolio and takes your portfolio into consideration. So really, what are the conclusions that we can see? So you need to keep it timely. FX management, whether you use Reval, so we focused on Reval today as it offers cash flow at risk, but any of ION's products will probably be very, very similar in what they can do, and also how we see our customer base. It varies in complexities across corporate treasuries, whether you have a large FX policy program, whether you've got large balance sheet hedging, cash flow hedging. It varies in complexities. And that's why we offer various different platforms and tools. It's because we know that not one size fits all, and we have to offer something maybe more enterprise for the more complex and something more simple for your day-to-day treasury needs. But we see that across not just Reval customers, but also the ION community itself, where we have the reactive who are using the system as their system of record. And as for the basics of things like level of cover, integrating with dealing platforms, we see the proactive who are leveraging some of the more complex scenario analyses and market rate changes. And then the more advanced treasuries who are using all of the platform to do all of the analysis, including even a recommended prioritized list of what you should do and when you should do it, based on out-of-the-box market data and out-of-the-box reporting as well.
Thanks, Jack.
Everything.
Thanks, Jack, for that interesting introduction to Reval. Peter?
Yeah, thank you, Jack. Interesting also. Now, it was a very clear explanation of how you could work with the scenarios. So there are no questions there. But you were mentioning something else. You were mentioning hedge accounting. Could you just briefly touch on that? I mean, if you do a trade, is that you're able to designate trades? Is that in improving efficiency, or could you just maybe label a couple extra words on this hedge accounting? How should I say? Is this assistance you mentioned?
Sure, absolutely. And it's a great question, Peter, as it's really one of Reval's strengths. When we interact with these dating platforms and we're sending trades to them, getting trades back, we automatically have hedge designations created with your documentation, with the appropriate scenarios employed, and also with the appropriate effectiveness testing done, all a single part of the single workflow. Really, all you're doing is executing a trade on the platform. Everything else in the back end is being done for you automatically as you do that.
Cool. That sounds great. You're mentioning kind of like a movement from the users from being reactive, proactive, and advanced. Where do you see? I guess the clients are a little curious about what their peers are doing. Where are people moving today? I mean, how advanced are they getting? Are you getting increasingly much demand for your advanced solutions?
Mm-hmm. I would say yes, absolutely. So if 18 months ago, the focus was liquidity because of the COVID situation. Now we're seeing, like we've seen after the financial crisis, people getting more advanced in terms of how they're mapping out their risks and how they're understanding their risks. So it's definitely getting more traction as people come out of the pandemic.
Okay. I guess that concludes my question, but thank you very much. Clear answers. Thank you.
Thanks.
No, Peter, I think we have time for another question.
Okay, but then I guess my question then will come back to my standard question, which I also threw about two other vendors, and that is how flexible with respect to your simulation of what if risk and Monte Carlo simulations are you? I mean, now you said you could use all the way back to 2000, but maybe one wants to zero out a period, like I mentioned before, the financial crisis, just to see how much at risk is my portfolio if we get another financial crisis on the back of this COVID crisis. Could one target that period and do the analysis on that?
It's totally user defined, absolutely. So you can search from 2006 until 2008, from 2008 until today. It's really up to you and parameterized by the user for what they need.
Okay, cool. Excellent. Yeah,
good.
Thank you.
Thanks. That will bring us from Jack to Kyriba, which is a client, a vendor that at least a large part of you will know already. However, this product is not that well known here, so we're all looking very much forward to get a proper introduction to this part of the Kyriba family, which is focusing on actually handling the global FX risk. So please, Andy, can you tell us what this is all about?
Yeah, happy to. Hopefully you guys can hear me okay. And once again, thank you to PwC and the audience for allowing us to walk you through some of our capabilities here. So just real quick, for those of you who are not familiar with Kyriba, we're really the leader in treasury and liquidity and risk management solutions. We've got 2,500 customers worldwide. We have a very broad set of capabilities covering, the key cornerstones of any treasury and finance team around treasury management. We have really strong capabilities from a payments. Obviously, working capital is becoming more and more important. But for today's purposes, we're going to really focus on this third pillar here, which is our active risk management. As you can see across the bottom, we don't view Kyriba as just a software platform. We're really a network for allowing companies to tap into a very vibrant liquidity network, whether you need to do payment processing with banks or trade FX deals through trading platforms, integrate with ERP systems such as Microsoft, Oracle, SAP, what have you. We've really developed a solution that is very nimble and easy to plug in to and get access to best-in-class capabilities here. As we think about the functionality that we offer here, we are truly an end-to-end solution here. One of the things that's very unique about our capabilities is the work that we've done on the front end of an exposure management process. We've really productized the ability to source data out of ERP systems such as SAP, Infor, Microsoft, Oracle. We have actually certified utilities that are designed to extract that information and provide that on a very timely basis. We have many clients that pull data from multiple ERP systems every single day so they can understand and manage their exposure. As you can see here, when you get into the heart of the FX process here, we really break this down to three major areas. The first is pre-trade. And if any treasurer has any experience in hedging, they'll tell you that the act of hedging is fairly straightforward. Once I know my exposure, I understand what the market is, I can place a trade. But the hard part is getting that exposure right. So we've really focused on helping companies, whether they're gathering forecasts from across the affiliates or bringing in actual information from planning systems and ERP systems, to have best-in-class capability in getting that exposure right. We source the data. We have rules-based processing and intelligence and data integrity checks all through that process. So you have confidence. And then we also have extremely strong analytics around FX exposure management, understanding where the exposure is coming from. It can certainly, like the other systems that you've been introduced to today, affect the application of your hedging policy, and have out-of-box integration, API integrations with all of the major trading platforms. Similarly, on the other side of the equation, we can pick up from once the trade's been placed, do all the proper financial transactions, do the mark-to-market, the valuation, support hedge accounting, and then for those clients that need the information pushed back into the ERP systems, again, strong API capabilities there. So really, from the source of the exposure to accounting for how you've taken care of that, we really have an out-of-the-box solution that can be plug and play and allow you to get best-in-class capabilities there. Now, one of the areas that we saw companies really focusing on last year was, how do I understand my exposure, and how do I take action given the circumstances of the COVID crisis here? And so what you're seeing here is an example of a company's, let's actually see if I can actually make sure this is animating okay. Yeah, okay, we're good. Let me go back a slide here. So this first view here is a dashboard view of exposures coming off a company's balance sheet. And in this case, I'm actually pulling data from multiple ERP systems, both SAP and Oracle. So they've deployed our out-of-the-box functionality to get the data out of that automatically. And so from here, they can see a top-of-the-house view and see their consolidated exposure. They can look at it by business entity. And if you see the currency pairs that are highlighted there, the hyperlinks there, if they actually want to understand what's underneath that, they can simply click on that and understand the payables, the receivables, the cash, intercompany positions that are creating that exposure. You can very quickly see your long and short position just to the right of the actual exposure calculation. And like the other vendors here, we also have very robust risk analytics on top of that. Now, what a lot of companies were trying to do as they were looking at their exposure last year is really trying to understand first, what can I do organically? And so one of the things that we provide, and one of the things we're extremely proud of in terms of how we change the economics of our clients' programs, is giving them the ability to drill down to understand where the exposure is coming from. So as we saw companies struggling with liquidity and risk issues, one of the things they were doing is going in and seeing if they could reclassify short-term intercompany loans, or if they can convert cash positions and reduce the exposure and actually lower the need to hedge where applicable. But for many companies, they actually wanted to go to another level and say, well, what's my current risk situation here? So this is actually a view. I'm going to kind of do a quick simulation here. What if analysis, as we've been talking about here, where you have what we call our core analysis. So the way to look at this is you have risk on the left side axis and the cost of carry, or the interest income generated by the hedges there. And this graphic is really showing an efficient frontier. So this company here, prior to the COVID, had about 20 million or 5 million in overall risk. You can see here the various actions that they're taking to reduce the exposure. This blue dot represents what their current FX program was producing in terms of risk reduction and the cost of those hedges there. So very quickly, this company could say, well, if I'm comfortable with the amount of risk that I'm taking out, can I do it at a lower cost basis? Or if I'm comfortable with spending the money, can I go ahead and reduce my risk even further there? So this is just out-of-the-box analytical framework to help them understand what they could do. Now, what was interesting during the COVID crisis is that scenario changed very dramatically here. Oh, I'll go back a slide here. Go forward one here. So this view here is using the same data in a new context here. So the risk nearly tripled here. So using the same underlying exposure, when the volatility shot up in April and in March of last year, we saw a tripling of a risk. But the other thing that we saw very graphically is that the interest income, as the central banks were intervening and trying to stimulate growth and try to hold on to the markets, the interest rate differentials changed. So in this scenario, the company could actually reduce risk even further and do it at an even lower cost basis, even though there's more volatility in the market. So very, very powerful capability to stay on top of what's happening out there. Now, behind this, there's a set of algorithms that are driving that. And so this graphical view here is showing you the various currency pairs that they have risk in. You can see the associated risk with each currency pair and the cost of hedging. And as they navigate through this, they can actually go through and determine, are there actions that I should be taking As you can see down here, there's sort of this little simulation box here is saying, well, I can see where I am today based on the optimization routines that Kariba has provided here. I have an opportunity to reduce my risk. And so these are the various currency actions they could take to further reduce their risk and cost. And as they click through this, they can actually move themselves here. So that's where they started. And by going ahead and hedging their cable position, they got a little bit closer to that efficient frontier. So these are the type of really sophisticated analytics that we're seeing clients apply during periods of high volatility. And they're also continuing to review this and provide this as management reporting around where are we today? What's our overall risk profile? What actions are we taking? And at the end of the day, how much are we willing to spend to manage our risk within our acceptable tolerance threshold there? So let me stop there, trying to make up some time for everybody. I'll take questions from Peter.
Thanks, Andy. And thanks for the presentation. I think I forgot to mention in the beginning that that Fire Apps might be the name that some of you know. So Fire Apps, I guess, was acquired by Kariba, and hence this is the new functionality that you guys have with the presentation you made. And I think some of the other vendors also was eager to come back on that comment you started with, Andy. But let's see if they've got any questions on this, Peter.
Well, it was yeah. Again, thank you, by the way, for a very excellent presentation. I should remember to say. But I guess I got a little carried away because you showed these good risk mitigation figures. It seems like you can see your exposure, and then you can click some hedges in, some suggested hedges in, which is like you can do like just my opinion, a little iterative evaluation, and then get to some desired risk level. I'm of course being a little curious. Is there an optimizer in there? Could you actually let the machine suggest an optimized hedge also, or how far are you in that area?
It's a great question, Peter. So a lot of the analytics and optimizations here are suggestive right now, but we are adding some optimization routines latter part of this year, where you're effectively applying some linear optimization around different risk and cost thresholds there to find the optimal hedging solution there. So that should be available. We're already doing that deployment with a client in Amsterdam right now, and that functionality should be generally market available in the second half of this year.
So I guess it falls natural to follow up with the question. So do you see the same? You see some movement from, as I said, from reactive, proactive to advanced, because that sounds advanced. Certainly to be looking at the ability to reduce risk versus the cost of losing risk and so on. I mean, is that the sense? I mean, you mentioned this Dutch client.
Yeah, I really agree with that, Peter. And I think we saw a couple of interesting things happening during COVID. One was in the past, a lot of corporates have leveraged the risk in structuring departments of banks to do this type of advanced analysis. And one of the things that we saw happening is that we started to see some conflicting results as correlation started to come under pressure during the volatility of the April and May timeframe of last year. And so corporates really didn't know what to trust. And so there's been an appetite to insource the more sophisticated risk analysis. So when things start to become, breaking the correlations, or you're starting to challenge the risk parameters, clients are wanting to be able to explain that and be able to go in and actually explain to the CFO, here's what's changed, here's how we can take a more conservative view on that risk profile given the change in correlations out there. But definitely a much, much more broad-based appreciation of more sophisticated analytics in the marketplace. I'm really seeing that coming down market, where before that was in the really super large caps. Now we're seeing it into the, even small caps that are, if they have a smart person, they'll take advantage of those analytics.
Excellent, thank you. I mean, now you being the last vendor today, I need to ask you the same question. I assume that the ability to switch period. I mean, now you're saying you are evaluating the risk and so on and so forth. you're probably using historical data, obviously, for this. And again, there is a possibility, I would anticipate, to also move that back to another historical period and use the economic or interest rate and ethics data from that period to do a, how should I say, special case analysis on the risk.
Yeah, no, it's a great point. I mean, one of the great advantages that we have by being able to automatically mine data from underlying source systems like ERP systems and planning systems is once we get a client up, they can go back as far as they need to gather the underlying exposure data from 2 years, 3 years back, and then do the same type of analysis that we've been doing here. And effectively, the model that I showed you there was an example of looking at my data in December versus looking at my data in April, and applying different shock values to understand the changing rate and interest rate environment there. So definitely out-of-the-box functionality.
Yeah, because I mean, you actually did mention yourself in your scenario analysis, saying that how things have changed, where we definitely knew that interest rates in the US was definitely a lot higher, and hence the cost level of hedging was another than it was following the COVID crisis. Yeah. And you said definitely you could see that, and you can see that in analysis, and that's kind of like what I'm looking for, because maybe history is not maybe the best guidance for what to do in the future. Maybe it's a selected period, right?
Yeah, I definitely agree with sort of putting a focus on specific events and trying to understand what was happening prior, during, and after. And I think those are where the greatest insights come from.
Okay, I think you've been pretty clear also in your presentation. So once again, Andy Gates, thank you for being with us and giving us this excellent presentation. I'll hand it to you, Kasper.
Yeah. I think you just managed to see this. Thank you. Slide just before. So what we are going to finish up with today is of course a thank you to all our vendors, and thank you for the audience for all the good questions. We'll leave you with a couple of things to consider. Peter, will you?
Yeah, I guess I have just one closing remark. There are a bunch of questions on this slide, but I think I will word them here verbally as well. So before we end by announcing the next event and ending the FX risk-focused Nordic Battle of Treasury, we would like to ask you a question to consider. And summarizing these questions actually on this consideration slide. If you have a TMS which does provide you with a comprehensive dashboard for the pre-support, what was the left side of my initial suggestion when we started this out, does the TMS then utilize this information? I mean, do you get value out of your system to allow you to analyze how best to hedge given your market scenario expectations, as well as the current hedge cost versus risk reduction relationships? Because I think if the question is no, if you don't get this information, if you're not able to get this information, I think that our selected vendors have today shown that this input can be delivered, and it might be a consideration of thinking about better using your TMS system, or how should I say, moving to advanced, as it seems like they say that people are doing. And with that, Kasper.
Yes, good. Then let's briefly touch upon the next session that we have here. So we'd like to announce our next session that will take place just before the Danish autumn holiday. So that's actually in quite a few months. So that will be in the beginning of October, and the subject for that is cash forecasting. So the question there is some of the challenges that we have seen at our client side, and in general in regards to cash forecasting. Even though it's really not. I think it's one of the most basic things about treasury. How much money do I have today, and how much money do I actually have at the end of the month? So are you able? Your current system, is that able to capture this perspective, both within the very short period, but also on a little longer term? how advanced are these capabilities in your current solution setup in terms of using AI or machine learning technologies to improve this accuracy of your forecasting? And actually, purely simple, how do you consolidate all the information you have internally? And of course, also how, in the end, how do you hedge this? So basically, these are some of the questions that we'll ask some vendors to help us answer at our next event in the beginning of October next time. So thanks again to everyone, both you, the audience, the vendors, and to you, Peter, for helping here with helping me being a moderator today. And we will, of course, get back to you for those who've asked some questions that we have not been able to answer today. And we will also put this presentation online as soon as possible.
Together with the slides.
Yes.
Yeah.
Thank you, and goodbye.
Bye.